How do I get my FICO score to an 800 score? Why are surging oil prices and Iran impacting mortgage rates? And what about the jobs reports that are coming out? How are they impacting interest rates? How do they look? Why are they impacting housing? I'm going to go ahead and tackle all these questions today. First, I'm going to go ahead and talk about the current events, the surging oil prices and such like that. And then I think I'll finish up with how I get my FICO score up over 800. I had a client last week. We had a lot of calls and texts back and forth as we were kind of talking. He closed about 9 months ago with a 713 score. We're looking at a refinance for him. But I was asking him if his score had gone higher or not. And the course of that conversation, I feel like, is very different than a lot of my credit conversations. And so I thought this would be a really useful um, conversation to share with you. And so um, if my background looks a little bit different for anybody that's used to seeing my videos, then it is because, as I always introduce myself, I'm Josh Thomas, mortgage broker in the state of Utah. But as of today, I'm not in the state of Utah. And so I'm traveling. So that's why you see I don't know if this is as attractive. Maybe if I threw my BYU flag up there, but it's back home, so I can't do that. To all the fans out there of other colleges across the country, we love you. Don't hate me, just a fan. So anyway, so yeah, let's go ahead and talk about the surging oil prices. So again, why are the surging oil prices and Iran news impacting mortgage interest rates? So, you've probably heard a little bit as I look at the news. I don't hear a whole lot about this, but the Gulf, the Persian Gulf, comes through that little strait. What is it? I don't know the name of it. Anyway, that little strait is kind of constricting about 20% of the world's oil supply. And so as a result, the world's oil supply now has less supply, and the continued demand is going to drive prices for that oil up. As prices for oil go up, why that impacts mortgages is because that creates inflation. When gas prices go up, things cost more to transport. We all have to pay more. So it's a temporary inflation. It's a very volatile form of inflation, but it drives up interest. It drives up home I can't talk, guys. So the constricted oil supply will drive up gas prices and other oil prices, which then creates that inflation, which then impacts your investments long term. So in the mortgage world, when they're investing in you and you want to buy a house and they're giving you a loan for 30 years, what'll end up happening if they're thinking that the future inflation is going to go faster, then it's going to eat away faster at their dollar. So then they're going to raise rates to compensate. So that's why inflation will drive up interest rates. And right now, the fear of that inflation, that's all it really is so far. We've seen oil prices go up, but it's been so short-lived that it's mostly just on the expectation of the impact it's going to be down the road. So going back in time over the last several years, most of the terrorist-related incidents, you'll see an immediate bump in interest rates, just like we did last week. But usually about a week later, you'll see them abate quite a bit. So far, it seems like Iran might be shaping up to be a longer experience. But even just last summer, when we initially bombed one of their nuclear facilities, that immediately had an impact on interest rates. It bumped them up, and then a week later, we were back to where we were the week before. And so we expect that at some point that's going to have an impact. But the longer this goes on, the more of its own unique impact it can create and kind of create a new set of interest rates. So we love interest rates when they're really good, and they were at their very best level the Friday before the attacks. And so maybe we'll get back there, but for right now, we're off those bests. Now, before anybody cries too much, we still have amazing interest rates. We're still firmly into the fives, but low sixes for the low closing cost scenarios. But if you're paying a point and a half percent on a conventional loan, you're definitely still in the fives. And FHA has been in the fives for a long time and still firmly in the fives. So in fact, on FHA 5/1 ARMs, we can get into the fours, guys. So really, really good stuff. Okay, so that's why the surging oil prices are impacting mortgage interest rates. Now, what about jobs report? So the jobs report is, so this one's a little different. This one's interesting. We actually had, crap, that's right. I was going to share my screen. I'm going to go and find this so I can share this with you guys, anybody that's watching. This will be kind of fun, as long as would have been great if I'd have thought of this before I actually started this video. Okay, let me pull this up. I just have it right here. As soon as I can minimize all the windows that are in the way, because I've got a lot of them. Even traveling, my computer gets opened up and I have a lot of windows open. I don't know about the rest of you guys and how you do it, but when I travel, I still got to take care of business. Where is that graph? Where did it go? Okay, here it is. You guys like that? Should I sing for you? Do you think that would go viral? It would be, what's the opposite of viral? I feel like that's what my singing would do. Let's see. Let's share my screen. And let's just take a quick peek at this. So that's probably big enough, but let's see if we can make it a little bit bigger. Okay, so what this is, you can see -35. These are all thousands. And then this is the jobs report as it gets reported each month. So first off, jobs reports come out every month, and in fact, some of them every week. There's a lot of different jobs report. The main kingpin, the main indicator that everybody pays attention to is the BLS, the Bureau of Labor Statistics. The problem is the BLS has been so wildly wrong for so long with their reports that they're starting to lose respect. And frankly, they should have lost respect a long time ago with their ridiculous errors. So, for example, last year in 2025, every month they came out with a report that said this is how many jobs were created this month across the United States. And then the next month, a new jobs report comes out, and so on and so forth. But each month, they'll then go back and revise the previous month and the previous month before that, and a third time as well, so 3 months. So they're always basically coming out with 4 updated jobs reports and revising the previous 3 with each report. Um, by the time they were finished with their revisions by the end of last year, 75% of the jobs that they estimated happened never happened. 75%. Um, Holy moly. That's talk about an error. But anyway, this is the latest jobs report. This one falls more in line with what expectations are, but again, because of the source, who knows how inaccurate it already is. But this one is showing in large measure a lot of losses. These are 34,000 job losses in the private education and health services, 27,000 job losses in leisure and hospitality. This one's showing 8,000 gains under other. This one's 10,000 financial activity gains. And so you can see the gains versus the losses are far, and this report came out this month with a net job loss. And given the trend of all the adjustments they've been coming out with, we kind of wouldn't be surprised if it shows 100 plus or even 200 plus thousand jobs lost. Now, that's a big deal. Some of you guys that I've been talking to are experiencing that. You've been having a harder time getting work, and or have been laid off and or have bounced around a little bit. And guys, this is actually, I hate to say this, but this is what the Federal Reserve intended. If you remember back in 2022 when they started hiking interest rates up, this is literally what they intended. There was too much money in the market, too much money in the streets. The Federal Reserve is also responsible for that. All the way back in 2009, they started purchasing mortgage-backed securities and treasuries, and they injected a total of almost $5 trillion by 2017. And then they paused, even started selling a little bit, and then 2019 they started again, and then COVID hit, and they continued in massive quantity. And by the end of COVID, well, whether it was the end of COVID or not, they ended at about $9 trillion of money that had been printed that was used to then purchase treasuries and mortgage-backed securities, and that activity is what brought interest rates so low. Now, they did so much of that as we all know, what was it, 2021? I think it was 2021 is when inflation hit almost 10%. The CPI index came out showing inflation at almost 10%. And we all felt it. We all recognized that things were getting more expensive. There were bidding wars going on across the economy. And so the Federal Reserve came out and hiked their interest rates up in a significant way. What was it, 5.25% in 18 months or something? And when they did that, of course, this is what they were going for. This is quite literally what they were going for. Because now you see a lot of changed behavior from 2021 until 2022. And you see it in my industry in housing. You see a lot less people overbidding on price on homes. You see people really having to contemplate whether or not they can afford to buy a home. You see people buying a home and kind of feeling house poor and really just slowing down their own personal economy and how much spending they're going to be doing. People are having to work a little bit harder, a little bit smarter now, really pull out the stops. And then on top of all that, with the Federal Reserve and what they've done, you've also got AI has come out. And so far, my experience with AI, maybe similar to yours, is pretty much if I can imagine it, AI can do it. It's seems to be limitless and in its different scopes. And of course, we're finding ways to reduce that how that transmits to human behavior, human assistance, and that means jobs. So more and more companies are finding ways to offload more and more onto computers through AI, which is then reducing their need for human staff, which is usually any company's most expensive um, resource. So what you're looking at, jobs report, what impact does it have? Well, as people lose jobs and the economy starts to weaken, then you have the Federal Reserve that says, okay, maybe instead of raising rates any further, maybe we'll lower rates. And that's what they've been doing for the last couple of years that you've been hearing. But they have been under the impression that jobs were still doing pretty good. And most economists have been trying to point out to them in really loud voices that jobs are not doing good. And so this is a report that kind of shows that. So what impact does this have on our interest rates? It's good for interest rates. And last week we had a bunch of bad news for interest rates because of Iran and the oil prices, and so that was driving interest rates up. And then the jobs report came out, and it kind of negated. It usually would have been an improvement for interest rates, and it was not. But it usually it negated a lot of the upward pressure we had in interest rates. So that's kind of what's been happening. Let's go ahead and talk now about my client. Um, Hopefully this is insightful to you guys, but credit scores are obviously critical when it comes to getting a mortgage. I think a lot of people recognize that. Let me go ahead and stop sharing my screen, huh? So let's go ahead and make this just a little bit bigger. Anyway, I think most people understand that credit score is really critical when it comes to getting a mortgage. I don't think there's too many mortgages out there that don't care about a credit score. I've talked previously about the ability to go down to an 800, or excuse me, a 500 credit score with FHA. And obviously, that's a thing. But what about how do I get my score to an 800? And I share this because it's from the perspective of a client who had a 713 score already. So a lot of people think, oh, I got a 700 score. That's good enough. That's all I care about. True, and he got closed. He got the loan that he needed, and we were able to get him closed and moved on. And that's the whole point. But post closing, we want to talk with our clients about getting an 800 score. Have everybody at 800. That's a goal that we have. Get everybody's house paid off, a 30-year mortgage paid off in 15 years without changing their payments, and have an 800 score. Those are our goals for you in most cases. So I had this conversation with him. This is a very successful businessman. He definitely utilizes credit in large quantities, much more so than your typical American consumer. He has got tens of thousands of dollars swinging at any given week or month. And so for him, it was really challenging as he thought, because my advice to him was what it is for everybody, and that is so on your credit, you've got basically two kinds of loans. Well, maybe a third if you got bad credit. So you'll have your mortgages, your car loans, your student loans, all your installment credit, and then you'll have your credit cards, your lines of credit, and things like that. Anything that's got an open revolving type of balance. Everything else, you might have collections or other bad stuff, but those are pretty much the lion's share of what you're going to find in your credit. The installment stuff has actually, I don't remember what hand I'm using now. The installment stuff, the mortgages, the car loans, things like that, they actually have very little impact on your score. Other than paying on time, they don't really have much impact on your score. What has the most of the impact on your credit score is your credit cards. And so the advice that we give to most people is you want the limit as high as you can, you want the balance as low as you can. Ideally, you want to have the balance under 10% at any given time. Now, if you're not actively doing anything with your credit, you're not applying for anything or getting new insurance or applying for new jobs or anything that anybody's going to be looking at your credit, then who cares, right? Do whatever you want. But about 30 to 60 days before you're wanting to get new credit of some kind, you're going to want to make sure that your balance is under 10% of the limit. Now, there's two ways to do that. If you owe $10,000, maybe it's kind of hard to pay that $10,000 off, right? And so, or in my client's case, well, I'm going to come to him in a second. Anyway, so a way that you can do something with that is to raise that limit, right? So maybe you're at the limit, you're maxed out. Well, if you call them and ask them to raise your limit and you haven't done that anytime recently, there's a good chance they're actually going to raise your limit, okay? So that's a behavior to pay attention to. I told him about an experience we had with our credit card. Um, I'm going to be a little bit vague just because of my own personal privacies and stuff, but I had this credit card that we had for years, and it had um, pretty low limit on it. And I finally reached out to the lender and asked them if there's a way that they could raise the limit. And I think I just did that online. I don't think I actually talked to anyone. And they did. They raised the limit up, I want to say a little bit more than double. So it was a pretty good jump. And that was nice. But ironically, I don't remember asking them to do it again, but they raised my limit up about 3 or 4 more times over the course of the next few years. And now that limit, I would say, is 8 times or so bigger than it was. Um, so we'll just call it 10 times for the sake of easy math. So what would your credit then look like if you owed $10,000 and your limit was, just here, if you 10x'd that limit, right? Now you're under 10%. Make sense? You haven't paid anything extra off, but now you're under 10%, which means that, your credit score is going to be in the best spot it can be in. So to be clear, a balance under 10% is often better than a zero balance and is definitely better than anything higher. So pretty good, success there. So for him, what I instructed him to do was actually there was a second spot, and I'll come back to that in a second. But for him, so I was explaining to him that this relationship, and he understood that, but he uses that credit in large measure for his business. And so he's frequently maxing it out. And so I just said, slowly but surely, contact the servicer, reach out, ask them to start raising those limits up, and just see what you can do to get those limits as big as possible. With his business in particular, I was really surprised that his limits weren't uh, honestly 10x or more than what my card was, and my other credit cards and stuff like that because of the quantity of business that he's doing. So ask and you shall receive. And then that puts his limits so far away from what his actual usages are. It enables his score to be better. Another piece of counsel I talked to about with him was business accounts. So if you're a business owner, which he is, you can do a lot of this off of your personal credit and onto your business credit. And he hasn't worked real hard on building his business credit. So I kind of walked him through my experiences with that, and he's going to go and attempt to do that. But one thing that's really interesting about business credit is a lot of lenders will not report that on your personal credit report. And even if they do, if you're paying it with your business, I can then omit it when you apply for a mortgage. You don't have to actually be able to qualify with that debt against your name as long as we can document 12 months of payments by your business. But when you apply for business loans, those business loans oftentimes don't have a report on your credit report. And so even if you do have a maxed out business line of credit or a business credit card, it often doesn't show up on your credit report. So there's some advice for those that are looking for an 800 credit score. Raise the limits. Obviously, paying off the debt's a good idea, but if you can raise the limits, that's also at least equally powerful. So raise the limits if you want an 800 score. And if it's for business purposes, maybe you consider opening a business account. Okay? Open business accounts, try to run business debt in your business's name, not yours. Hey, novel concept, right? But run the business debt in your own in your business's name. It oftentimes doesn't show up on your credit report. So hopefully those are some good pieces of advice and insightful to those listening. Hope you have a great day. Thank you for your attention and joining me. And I don't know, again, if you're working out at the gym, if I'm a good gym buddy, give me some comments. It tells me how I can be a better gym buddy for you. Or if you're driving down the road, or if you're whatever, tell me what I can do to help be a better buddy, I guess there. So maybe I need some music or something to go with my incredible singing voice. All right. Well, this is Josh Thomas, mortgage broker in Utah, signing off for the day. Have a great rest of your trip or workout.